My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You might think this whole market is hostage to the trade negotiations with China. I mean, that's certainly how it feels after today's bruising, right? With the Dow plunging 280 points, S&P tumbling 0.66%, NASDAQ sinking 0.55%. But that's just not true. If the trade war were really all important, the averages would never been able to surge to record levels over and over and over again. As tense as the negotiations may be, China is simply a much smaller issue than most people seem to realize. So if that's the case, what the heck just happened over the last 4 days? Why has the action suddenly become so frightening? What does it mean for your future in your portfolio? Okay, a week ago, we learned that the free traders in the Trump administration, there you got to think about Larry Kudlow, the president's chief economic advisor, and Steve Mnuchin, the Treasury Secretary, they had high hopes for a deal with the Chinese. They floated the idea that maybe China would be willing to open up its economy to American financial companies if the president would give them a stay of execution on his scheduled December 15th trade hikes. But the hardliners in the White House, no, they warned us. They warned that if the free traders kept talking up the prospects of a deal, the Chinese government would start pushing for better terms. That's been their style. We've seen this before. Every time Trump seems willing to agree to something, they try to move the goalposts. Still, for a while, the president seemed quite taken. He was willing to side with the free traders. He spoke positively about the deal. And that allowed the stock market to surge again. Some people think it's manipulation. No, it's the way it is. Again, we've seen this before. Stocks rally in anticipation of a trade ceasefire. Rug gets pulled out from under us. We give back those gains. This time, it's harder to tell who's at fault. Remember, our government passed a bill imposing some sanctions on Chinese officials for their crackdown in Hong Kong. Pro-democracy. And suddenly, China was no longer content to ask for no more tariff hikes. Instead, they wanted a rollback of the existing tariffs as a precondition for any deal, even the so-called Phase 1 agreement. And that's exactly what the hardliners predicted would happen. So the president struck back. First, he brought back those tariffs on steel imported from Argentina and Brazil because they've devalued their currencies. And more importantly, any country we don't have tariffs on is a country that China can use as a middleman to dump their steel on the U.S. market, depressing our prices. Second, rather than commit to a bad deal, Trump decided to throw a real roundhouse, saying it might be better to wait until after the election to make any agreement with the Chinese at all. And that's what torpedoed the averages today. But I've been telling you for ages that you shouldn't get your hopes up about a deal because the two sides are simply too far away from each other. These are those 7 deadly sins I talk about, which is far more difficult than just buying some soy or making it easy to have a bank, have a business in China. The thing is, despite how it's often portrayed in the media, the Chinese Communist Party, get this, as a newsflash, is just as fallible as any other political organization. At the end of the day, they're human. They make mistakes. They make misjudgments. They have a tendency to be overconfident. This time, I think the Chinese government really overplayed its hand. They were betting that President Trump would be willing to make a deal thanks to the impeachment process. No serious person in this country believes he'll be removed from office, but it might hurt his re-election chances. China was hoping he'd accept worse terms for a quick political victory before the election rolls around. Well, Trump, he just shut that down. I also think China's underestimating the common ground between Trump and most of his potential Democratic opponents on this very issue. Okay, Biden would probably end the trade war. But Warren, Sanders, they might be even tougher on the Chinese than Trump. So the possibility of a stalemate on trade for the next year or even longer is a very real one. Don't forget, they are very anti-coal, and China's decided, hey, we need all the coal plants we can get. Now, all of this news broke over the last couple of days. At first, Wall Street seemed skeptical that Trump actually meant business. Maybe he wasn't really going after China when he put the kibosh on steel from Brazil and Argentina. By the end of the session yesterday, though, there were rumblings that the trade talks were a little off track. But this morning at 4 a.m., the people I call the pajama traders, those are people who trade in the pajamas and tend to have to be half-wits, mountebanks, knaves, and charlatans, well, they started feeling bullish, setting the futures higher, giving the appearance that we might have a rebound. Then the president made that offhanded comment at 5:18 about how the trade talks might take a lot longer than anyone expects. Plus, he flaunted plans for new tariffs against the French, right in front of the French president, doubling the import duty on cheese, wine, fancy goods, because France insists that it can tax American tech companies with impunity. And that sent the futures cascading down, and only the whole market rolled over. Okay, that's the history. What happens now? Simple. We have to remember that not everything hinges on trade. We always seem to forget that. It's a common refrain, particularly from the mainstream media. Plenty of companies will do just fine if these tariffs stay in place forever. And aside from China, there are a lot of things that are going right, including getting a lot of business out of China. First, the United States is a service economy that's pretty darn close to full employment. And when you get service and full employment, you get a lot of sales and a lot of money, particularly in housing. Second, we have powerful secular trends that are going on here, like digitization. We'll talk to Salesforce and Coupa later. Medical innovation, a lot of those biotechs being taken over, that don't have anything to do with the trade war. Third, when tariffs go up, economic growth slows a bit, and that causes bond prices to rise. When bond prices go up, their yields go down, and then money flows into higher dividend-yielding stocks. Fourth, some of our retailers are so powerful that they can squeeze even their Chinese overlords, so to speak, to keep prices down. If you have enough scale, the tariffs simply don't matter. Go ask Walmart, go ask Target, go ask Amazon, they'll tell you. Finally, when you look at the composition of the averages themselves, the industrials are a lot less important than they used to be, which means the tariffs can't hurt us as badly as you might think. Ironically, China's been so great at destroying American manufacturing, they've created a world where the United States doesn't have that much industry. And for that matter, industrial stock market capitalization left to lose. In other words, it hurts China a lot more than it hurts us. And the longer these talks go on or drag on, the more business you see taken out of China and going to the Philippines, going to Indonesia, going to Vietnam, going to Thailand, going to India. So then, if that's the case, why can't we shrug off these trade talks entirely? Mostly tech. Yet we have immense technology companies with tons of business in the People's Republic, including the largest company on earth, Apple. The idea that Apple stock could somehow crash if China decides to go after them has been a major theme on every one of these down days, even as the stock has rallied more than 100 points since people started fretting about this. But what happens here is that the negatives surface first, and they bring everything down. Then the stocks that don't have anything to do with China bounce back. Nevertheless, much of tech keeps getting slammed, and that's the real issue we face right now. While I think that will eventually create fabulous discounts, we're not totally there yet. Bottom line, the market is slow to figure out the positives, very fast to identify any negatives from the trade war, which is why we have days like today. And unfortunately, I think we could have more faux, that's F-A-U-X, trade-related pain before we're ready for some gain. Ed in New York. Ed.
Yes. Hi, Jim. Happy holidays to you and your family.
Same to you, Ed. What's up?
Jay, I'm calling about your take on CVS stock. I know that Starboard has taken a position there. And I think, anyway, that I feel that CVS is a well-run, diversified company. It's one that's not subject to the whims of trade tensions or tweets, et cetera. And at this point, I'm wondering, gee, I've done very well. It's been on the tear lately.
Right.
You know, should I take some chips off the table? I should sell?
Well, let me tell you what we did.
It
was among my, if not the largest position for my charitable trust. You can follow what we do there by joining the ActionAlertsPlus.com club. And we actually sold some today. Why did we sell some? Because it has been straight up, and it was up yesterday again. And you know what? Bulls make money. Bears make money. Well, hogs. So wait till it comes down. Don't buy any here. And if you want to do a little, it's okay. Marvin in Florida. Marvin.
Yes.
Marv, you're up.
Okay. How you doing, Jim?
Doing well. How are you, Marv?
Boca Raton, Florida. Okay.
Well, how can you not like Boca Raton?
Oh, I love it. It's, I tell you, it was like a wish that I left, believe it or not, I left Albuquerque, New Mexico to come here. And I love it. It's very healthy. And I just turned 80.
Huh.
October 1st.
Incredible. How about a stock?
Okay. It's called Canopy.
Yeah.
And it's up 3% today in a down market.
Well, look, this stock is dramatically oversold. It's got a huge amount of cash. You know, we did a piece which just said, listen, you got to go into strength. You got to lighten up. Now, why is that? Because the industry turns out to be wildly oversupplied with cannabis. Now, that doesn't mean these stocks can't go up, and this one would be the consolidator. But can we please see who the CEO is going to be before we take any action? And I'm glad you like Boca, although Albuquerque, Boca, it seems like 6 or half dozen, frankly. Let's go to Donald in New York, please. Donald.
Hi, Jim. Happy holidays.
Same.
Generally, I'm a long-term dividend income investor. Most of my portfolio is made up of dividend aristocrats.
Okay.
But lately, I'm not trying to catch a falling knife. But lately, I'm finding it very difficult to resist that dividend on Macy's, sitting with all that $15 to $20 billion in real estate.
Right.
What are your thoughts?
Well, first of all, I think that's an overvaluation of real estate. The problem with Macy's is the same problem I have with master limited partnerships. If you don't have any growth, no one cares about the dividend, or some of these, like the Annaly Capitals. So Macy's has to demonstrate growth before I want to buy that dividend, and they have not demonstrated growth, so therefore they are in the, and I can't recommend the stock. But I do want to go to Mike in Ohio, please. Mike.
Booyah, Jim.
Booyah, Mike.
From Cleveland, Ohio. I wanted your thoughts on UPS. It's been a great
I like UPS. I think that quietly David Abney has emerged as the person who spent the most money in order to be able to build up the infrastructure that's needed to be able to handle Cyber Monday, Tuesday, Wednesday, Thursday, whatever. And I think it's the stock to own. You know, I've been a big FedEx backer, but I've got to believe Abney has really done what's right and that's the one to own. Okay, remember, not everything is hostage to the trade negotiations. The lack of a deal is going to create some buying opportunities. A lot of names. I said that yesterday. I said we got to come down. But you know what? We're getting there. We're getting there. The real issue's tech. The trade uncertainty is a real headwind for that sector, particularly for Apple, because this is the one everyone thinks has to crash, except for me. Remember, I say, own it, don't trade it. Mad Money tonight. As the market continues its decline, does it feel like it's time to throw in the towel? Okay, not so fast. Don't make a move before you hear my take. Then Salesforce report after the close. I'm going to be crunching the numbers with the co-CEO fresh off the report. The stock's getting killed. And therefore, is Coupa the way to play the cloud? It's a cloud prince. It's become a little bit more of a pauper lately. I'm not so sure that is correct. I'm going to be talking to the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.